The SPAC boom of 2020 and 2021 was one of the greatest transfers of wealth from retail investors to Wall Street insiders in recent memory. Now, in late 2025 and 2026, the market for SPACs is back. And the man who arguably embodied that era more than anyone, Chamath Palihapitiya, you may know him from an All In podcast, or he was an OG guy at Facebook who made a lot of money on their initial stock offering. He has just raised $300 million to do it again. So the question is, has anything actually changed, or are we just running the same play with better PR? Mike, would you explain to us what a SPAC is?
Oh, thanks for throwing that over to me,
I can
right?
do it. I mean,
It's a special, you can think of it like a special purpose vehicle
yeah,
because you take it as it's a pile of cash that you do an IPO with, right? And then what you do with that pile of cash is you then invest it in a private company or buy the private company. So it becomes like a merger.
yep,
And then that allows that private company to go through a sort of shadow IPO much faster than they could have the traditional IPO route. So it's like an end around the traditional IPO route could be 6, 12 months or longer for a traditional IPO, 12 to 24 months. For this, it could happen in 6 to 12 months, so much faster. And to be honest, private companies, some of them, they need capital, right? They're hungry for it, but it's very difficult to do the traditional IPO. So that's like a value proposition for them is to go through the SPAC to get access to the capital.
yeah. What happened in the 2021, 2022 era is that these were really popular. And the theory is because that investment capital was low, liquidity was low. And so they needed to come up with a different way and introduced SPACs here, which is a neat way of getting a company to be public quickly. And it hasn't panned out too well. We're singling out Chamath because he's a public figure, he's well known, and he's got a terrible record with these things.
But
And
hold
he's
on.
doing it
But
again.
let's be careful.
Yeah,
When we say it hasn't worked out too well, for whom? Because that's the point.
fair,
That's
fair,
where the
fair.
that's where the controversy comes.
Yeah,
Chamath has done well, right? The question is, I think there are several angles. How did the post-merger companies do? And actually, post-merger companies don't do well in general.
yeah,
And if you are already struggling for capital, then you might have problems with your business model. It might not be ready to scale. What is it going to do with all that cash? So they tend to underperform. So the thesis from day one as a prior of probably not going to work out as well as we think before we do the merger, right?
yep,
So then the retail investors would suffer from that. While, and this is where the controversy comes from in SPACs, the founders of the SPAC legally can do like 25K up front, raise about 300 million, and they get like 20% of the post-merger shares. So they have a heavy incentive to do any deal. And this is the criticism, right? That doing a deal is better than returning the money to the shareholders because it's held in a trust,
yeah,
right? So once they collect the cash, it's held in a trust. And if the investors don't like the private target that they want to make a merger with, then they're free to leave, right? So those are kind of the mechanics. And there may be a structural problem there where there's just an incentive. This is a critique for the founders, the Chamaths of the world, to push to any deal because they're going to bank. As long as it goes to a post-merger, and usually there's some vesting. And to be fair to him, I'll tell you what he was trying to do. They usually have a vesting period. I don't know, you can correct me, but about a year. So all the merger has to do is survive for a year. And the whole trick is that once that 20% has converted of the founders to common stock, it's liquid. And they can sell it and bank big time. And they have. Chamath, I think to his credit, he was trying to say, but let's give it a stock performance like warrants, right? So if it's 50%, 75%, 100%, and the idea was there that it would only vest one third, one third, one third, then those retail investors presumably would also benefit because the stock improved,
yeah.
right? But again, over what time period? Because if I can get it up 100% on pure hype, like an Allbirds, let's say Allbirds was one of them, it's not, but if it were, and I just attach AI and I say, hey, post merger, we're still working out the integration and working on the business model. After a year, maybe people are still bought in, the stock rises and rises and rises. And then you can cash out before it collapses, if it's going to collapse, right? So
Yeah.
it's really an interesting model. I was not so aware of it. On the one hand, there's the benefit for the private company to get access to public money. On the other hand, so that could be a benefit, but on the other hand, the structure of it tends to favor the founders of the SPAC, and it's not clear how retail investors can benefit, and it looks like they've lost mostly. That's the controversy. But again, this is an innovative model. I wonder if there are innovations on it that can improve it, but it's probably going to get regulated even more than it already has
Yeah.
because of that.
Probably. I mean, I would say, a number of things apply here. So if you're looking at it from a VC point of view, you would probably say that, well, we've got a big failure rate, but the ones that do succeed, they succeed really big and it makes up for it, right? So maybe.
Or, and this is the game, you exit it before it's clear that the bit. So, what is success? This is the whole point.
That's true. Yeah.
Success for a VC is often just the exit. If I get the exit, somebody bought it. Either you go to IPO or you go to M&A to a corporate.
Yeah.
Somebody bought it, you exit. That does not mean that that business will become a successful business model.
Yeah.
So it always comes back to how do you define success and for whom? And that's where the controversy lies here.
Yeah. Well, let's look at how, I would define failure for investors. Let's say Virgin Galactic.
This is the classic example, right?
This is Virgin Galactic Holdings. So this was SPAC 1, I believe, for Chamath and his social capital, their firm. They merged with Virgin Galactic here at the end of 2019, to my recollection. It did spike up, good for them, but then it has never, ever reached that point again. So for anyone who was in the long hold here and didn't sell when the rug was getting pulled out, they're just hosed. They're never going to recoup that difference, right? So if you didn't get out at the right time and you're not an insider, then you're getting hosed. And that's pretty much what you see with a lot of this stuff. And really, IPOs these days are overvalued almost all the time. Like there's very few IPOs that do well.
Well, if you wanted to be cynical, the people running the SPACs are obviously sophisticated.
Yes.
They probably are, right? It's not like they don't know the probability of a post-merger success.
Yeah.
This will be my critique, right? These are smart people.
Yeah.
They also know when their stuff vests. So they have an incentive to make sure that the narrative supports the stock rising, releasing announcements, etc. But when it vests, they're free. But I'm not going to accuse anybody of anything, but I like to look at the structures because the structures of these deals help you predict what the behavior might be. And the problem might be in the structure. And because when I was looking into it, it's not so easy to understand on first sight. So if you're a retail investor, how many of them really know that their money's going into this or understand the vehicle? I don't know. I don't know the answer, but that's why the Romans always said "caveat emptor," right? Like, be careful what you're buying.
If I'm a successful businessman and one of the OG vice presidents of Facebook who made a lot of money on that initial offering and has done, has created his own firm, he's essentially a billionaire in his own right today, comes to me with this great idea, I'm going to buy into it. It's too complicated for me to understand. This is a lot of my problem with Wall Street and financial insiders is that it's not super difficult concepts, but it's packaged in language that's confusing. It just ends up being this really complex terminology, and it's just packaged to be confusing and elite.
There's also another mechanism. The other mechanism you're describing there is there's a lot of investment based purely on social proof. Because that Facebook person was successful one time, survivorship bias kicks in, means they must know what they're doing with every other investment, but that's not the way probabilities work.
Yeah.
It does not mean that they know what's coming next. And you see this behavior among investors. Investors are supposed to be contrarians. take risks on the unknowns, the founder that believes everything, yet they won't talk to you unless they got a warm intro from somebody who already has social proof, right? So what you got to be aware of as an investor, and I'm not blaming the game, right? That's the game. It always has been. It always will be. We trust people that we know and that have credibility. Be careful though, right? That it's not only social proof. Still, you got to do your due diligence. You got to understand the vehicles. You got to understand the underlying business model that you're buying into. You got to know the probability in this vehicle that post mergers simply don't return the value over the long run. Doesn't mean this one won't, but in general, on the average, they don't, right? That's the point.
Based on the social interactions, you might get referred into something, and your buddy might say, I know this guy who's just making a lot of money from my friend Bernie Madoff. You got to meet him.
Yeah.
And you're going to get into
Yeah.
some Ponzi scheme. Like it can happen. It can really happen. And these
Well,
things.
and if you got in when that thing's going up, you get immediate feedback that, oh, that was the right move.
You do, yeah. If you get on the high
Again,
end of the Ponzi scheme, yeah,
next greater fool theory.
yeah.
If you're on the upswing, as long as there's some other fool who's also not doing due diligence, who buys it when you exit, you won. Whose fault is that, right? Because a lot of I've seen some investors say, "Well, look, you should have diversified, right? This is part of the game. You put risk capital in. Maybe you can write it off on your taxes." But it comes off kind of like the famous quote, "Let them eat cake,"
Yeah.
Like because you're in the Versailles Palace, you can tell the peasants out there, while you banked on 30, 40 million on the deal, they may have lost their life savings. That doesn't help them. Let them eat cake. They don't have cake. They got barely bread now.
Well, there's this bro culture that
Marie Antoinette, yeah.
there's this bro culture that glorifies bad behavior in a way. It glorifies, making the money at whatever the cost is, what are the consequences. As long as you're making the money, you're doing right, doing well. So, maybe it is that customer's fault that he should have known those beans weren't going to turn into a magic beanstalk, right? Like I don't know. It's repackaged
Well, I
snake
think
oil. It's sophisticated, but it's still
But snake oil implies that it's not their philosophy, right? If their philosophy is, hey, this is the game we're in, it's a game of probabilities, and that's the only game they've known. They go into it with the mindset, I might get burned. The difference is though, they already have the capital.
Yeah.
So they can play that game. And if they lose, they can jump on the next horse. The person with a little capital can't play that game, right? They got to be careful about which games they play. So I think it has become a part of the whole culture and philosophy and ethics even that to normal people it looks like snake oil, but we don't know what's really going on inside their heads philosophically. Do they really see it that way, or do they actually believe in this game? Or do they know? Do they know, hey, post mergers mostly don't work, so we got to get out. When it gets to the high point, we have to guess, right? So I don't know, man. There's a lot of gray area there. But what I encourage everyone to do, educate yourself.
This shape reminds me of what we see now in these meme coin rug pulls. So let's say Melania coin. It got rug pulled. The president of Argentina had a meme coin. It got rug pulled. So what that means is that inside investors are taking early positions before it's publicized. So they buy early, number one. Number two, there's also a liquidity backing meme coin. So there's actually like a Solara or a Bitcoin currency underneath it, like providing liquidity. And so these people who set up the coins will literally just pull out the liquidity. And so the entire bottom falls out of the meme coin, which happened with Melania and again the president of Argentina's meme coin, and it's a rug pull.
Hey.
And so only the insiders are making money, and there's no shot for anyone on the outside to make money.
If you wanted to go full on conspiratorial, for a while there, every time Anthropic announced a new capability, you would get the same chart. And how many of the people knew that announcement was coming? I would love for some finance professors, researchers to look at that, because we see this in corporates and in Congress both, that before major announcements come, you see trades.
Yes.
Right.
Yeah.
Right. There's the Pelosi, what is it called? Pelosi put.
Yeah.
Yeah, the Pelosi effect, right? Well, she's just one. They're all doing it.
Oh, yeah.
And it's natural, right? It's natural to have that temptation. I don't know if it's actually happening. You saw it in the PayPal chart with Burry, right? Same thing. What of that is just the market overreacting? What of it is, hey, it was always going to crash back down because the fundamental value is where it ended up.
Right.
I don't know.
Well,
Difficult.
that's interesting. Stay away from SPACs would be my suggestion. Stay away from financial vehicles unless you know a lot about them and know exactly what you're getting into. My suggestion is go index funds. They're boring and they're easy, and you're going to get probably what you expect. Anyways, that's my 2 seconds of preaching.
Hey, you've just watched a clip from Show Your Priors podcast. We hope you liked it. Check out our main channel for full episodes. We're also anywhere podcasts are found. Give us a like, subscribe. Doesn't cost you anything, but helps us out a ton. We'll see you back next week.